The biggest tax break you've never heard of. This is something that I had never heard of until I got into this fancy world of bookkeeping and accounting and tax. I hadn't encountered it a lot in my estate planning practice, and it's something that my own accountant never talked to me about. I wanted to let you know about it because there are some times when you're going to want to uh, pay attention to your business income and massage it sometimes to get you to excuse me, to a place where you can have maximum tax savings and still have maximum fun with your money. Okay. So, fair warning, this is slightly complex. It's not that complex. There's just a lot of numbers flying around and there's a lot of definitions flying around. It's important to understand and remember what those are. That's why we're doing our little talk in this way. Okay. So we're going to take notes. We can refer up, we can refer down, we can do whatever we want. Okay. But we're going to start with an example. Okay. This is Mary. Okay. Mary is our person that we're working with here for forever. And in the case when Mary is married, it's going to be John. Okay. Mary and John. So Mary owns a business. Okay. Mary owns a business. That's what we need to know. Okay. And when we're talking about Mary and John, you'll see where this goes. All right. When Mary, for purposes of our talk about the biggest business tax break you've never heard of, let's say she owns a law firm. Okay. In fact, let's say she owns we're going to change this around too, which is why this gets a little interesting. Okay. So for now, Mary does not own a law firm. She just owns a regular old business. Let's say she sells pies. Okay. She's a pie salesman. She makes pies and she sells pies. Okay. She's got a couple different things going on. She has 100K of net income from her business. Okay. This in this case, this business, because she's smart. Okay. This is an LLC taxed as an S corp. If you are wondering why this makes her smart, go watch some of my other videos and you will find out. All right. Mary also has a salary of 50K. This is from her business. Okay. This is where the S corp election comes in handy. She also has $20,000 of business interest. Okay. We're just doing this for the example. She took some of her money, loaned it out to someone that was doing some real estate and she flipped it. She flipped that money and made 20K business interest over the year. She also had 50K of capital gains. Okay. She sold a rental house and had 50K on top of that. Okay. Don't worry about any other details. Okay. We're just trying to be simple with these things. Okay. They're going to help us as we work our way through this. Okay. Now that we know this, when it comes to the biggest tax deduction you've never heard of, by the way, what are we talking about? We're talking about this section 199A deduction. Okay. That's what we're talking about today. Let's make it bold because it's important. Okay. Now, inside of this deduction, we have some definitions that are important to understand. And you don't actually need to know all of these definitions for yourself, but it will help as we talk through these things. First of all, we have taxable income. Okay. This is like what you normally think of as income. So if you, in Mary's example, it's all that stuff from above. Okay. And that, if you add all that together, is 220K. We have another definition, which is adjustable. We're going to call this adjustable tax. Oops, what happened there? Okay. This is your taxable income minus, we're going to call it TI, minus capital gains. Okay. This will be important later. I have no idea why the IRS makes these things so complicated, probably just to give people like me a job. Okay. In Mary's case, this is going to be 170K is going to be her adjustable tax income. Why? She's got this 50K a capital gain, and we're going to take that off the top. Okay, what they're really looking for, I think, in this case, is when they're talking about adjustable tax income, they don't want investment income in there. Okay, they want just regular, sort of regular old income. The next definition that we need to know about is called qualified business income, also referred to as QBI. This is the net income of your business, of the biz, minus capital gains, dividends in business, interest. All right. So for Mary, what is that number? What is her QBI? If you said 100K, you are correct. Okay. Now, why don't we count her salary? Because that's technically an expense of the business. Okay. That goes to her bottom line, but it's a write-off from the business. So we have 100K for the qualified business income. We have 100K of net income minus this business interest minus capital gains. All right. So 100K is that number. The next thing that we need to know is wages paid by the business. And this one's pretty straightforward. It's the wages paid by the business, except it does include the wages of the business owner. Okay. So in this case, Mary's 50K. We got that? Perfect. The last thing that we need to know is something called qualified property. This one, like I'm really talking to sort of law firm owners, service-based businesses for the most part. But some of you listening may have this. Qualified property is the unadjusted basis of property purchased in the last 10 years or not fully depreciated yet. All right. So what are we talking about here? Um, an example, like let's say a law firm owner example would be if I went out, Mary, we didn't have any of this because we're not going to use it in her example. Example would be law firm owner buys, 15K of computer equipment 5 years ago, still not fully depreciated. His QP, which is what I'm calling it, I don't know if everybody else calls that, is 15K. Okay. We're gonna need to know this later. Okay, so we have all that. We have our definitions. Okay. Taxable income, adjustable tax income, QBI, wages, and QP. Still following along? If not, you know what's great about this? It's a video. Rewind it and listen to it again. This is whiskey, by the way. This is bourbon, technically. Buffalo Trace. This is something that is required when discussing these types of things. All right, now that we have the definitions in place, here is the general rule. Okay, this is the thing that you really want to at least have a good idea about off the top line. Okay, the general rule is this: if you are under a certain uh, taxable income level, you get 20% off of your income. Okay. of in the lesser of one of two ways. Okay. That probably didn't make any sense, but it's about to. All right. Now, these are the let's call this the rules inside of the rules. Okay, is what we're talking about now. This certain taxable income is 191,950 if single, and 393,383,900 if married. All right. So translation: if under these numbers you're getting a 20% income deduction. Okay. That's all we need to know for now. The way that this is calculated, okay. All right. Actually, yeah. We're not going to have any more rules inside the rule right now. Okay. Calculation is going to be the lesser of 20% of your QBI or 20% of adjustable taxable income. Okay. All right. Let's let that sink in real quick. Okay. If you are under, so if you're single right now, think about this number. If you're married right now, think about this number. By the way, these numbers go up every year. Whichever number that is, you are going to take, if you are under these numbers, then you're going to deduct from your income 20% of your QBI or 20% of your adjustable taxable income, whichever is lower. Okay. Now remember, we calculated these for Mary. Okay. Mary's QBI equals 100K, right? QBI is net income of the business minus capital gains, dividends, and business interests. This is her net income minus this, minus this. Her adjustable taxable income, ATI, these actually aren't acronyms, but I'm tired of talking so much. Adjustable taxable income, remember, is the taxable income minus the capital gains, which in this case is 170. Okay. Now, if we take 20% times both of these, so times 0.2, the math is easy, right? 20K. If we take this times 0.2, I don't know what we get, but it's bigger than 20K, right? 34K. Okay, we're going to take the lesser one. This one's going to win. Okay, so basically, she's going to get to just sort of chop off 20K off of her income when she's filing taxes. If you let's assume that she's in the 25% bracket, that is a $5,000 tax savings. Okay, not bad. Just may have saved some of you some money. This is why it was kind of crazy that, a lot of accountants, they don't talk about this. Maybe they just do it, but there's some things that you may want to do to get to these numbers if you are slightly over or if you're way over. Okay. Now, let's talk about what happens if you're over. The numbers. Okay, so this is where they make it overly complicated, I feel like. If you are between 191, okay, if you're between two numbers, there's a phase out. Okay, there's just some math that's done. I'm not going to go into that because it's even more complicated than this, and I'm going to lose you. Okay, just know this: if you're single, it is between 191,950 and 241,950. Okay, married. This is what is it? 3838 3900 and 483 900. Okay. You're not going to get zero, but there's just some more math that's involved to figure out what you're going to get. And it's going to be less than sort of your overall 20%. Okay. Basically, if you're rich, they just don't want you getting as big of a break. Okay. What if you are over the highest number? Okay, which is 241,950 and 483,900. What happens if you're over those? New math. Okay, we're doing new math if you're over those. What is this new math? Okay. The new math is this. It is the lesser of, again, so the lesser of number one, 20% of QBI. So they're still opening the door for that. Or the greater of, this is why they mess with you, because it's like greater of, lesser of, all mixed into the same equation. Okay. The greater of 50% of W-2 wages of the biz, or 25% of W-2 wages plus 2.5% of your QP, of your qualified property. Remember what we talked about up here with this 15K, not depreciated all the way? That's what we're talking about with this QP. All right. So let's change the math here a little bit. And let's assume that the taxable income, the total taxable income that we talked about here, this is now going to be 300K. So example 2, this equals 300K. And this is going to equal 80K. Now, why is this? Because as you creep up in taxable income, you may want to creep up your salary just a little bit. Okay, so for example 2. You don't have to, but it's a consideration. So here's what we need to know first. If we're at 300K and Mary is single, we are now over this number. So we have reached the full phase out stage. Okay. Let's do this. Just gross income, 300K. Salary. Oops. 80K. All right. So all we're going to do is the math. All right. So now, if the salary, so there's more changes to be made. If you take 300K as the net income, we're going to be raising this QBI up to 220K. Okay. And we should do that too. Right? Because we have 80K of income. We have 300 total of adjustable tax income is going to be that. So we're going to have 220K for example 2. This is where this gets kind of crazy. Why I wanted to write it all down and scroll around for you. Okay. So in this example, we're going to take the right the lesser of 20% of QBI, which is 220. Oops. Yeah, 220 times zero point 0.2, which equals, I've already done the math. Let me find it. 44K. Okay. Or the um, the greater of 50% of W2 wages, which in this case equals 40K, right? Because remember, we have 80K salary. She's the only person that's getting paid in this company in this example. Okay, so 40K, or 25% of W2 wages plus qualified property, which in this case is going to equal 20K because there is no qualified property. Okay, she's renting all the things that she uses for her business. Okay, we got this down good. So we're going to start here, which is the greater one, this one, right? So 40K is our number here. And then we're going to take the lesser of these two numbers. So we're going to take the lesser of 40K or 44K. 40K is the number. That's where we're going to arrive at. So what you can see is she's getting knocked off about 4K of income. Not that big of a deal, maybe 1,000 in taxes, but nevertheless, that's what's going to happen. Okay. So Mary deducts 40K from her income. Sweet. Now, there's one wrinkle. Okay. And it's not going to be great if you are a law firm owner, which a lot of you are, because you're my people. Okay. By the way, if you're a law firm owner, I want to help you. You're my ideal client because I'm a law firm owner and I know how to do books and taxes for law firm owners. Okay. There is this special exception, a bad exception. Okay. For specified, I'm going to put these in lowercase, specified service, trade, or business. All right. What's the exception here? If meet this definition and over the thresholds here, these two, 241 and 483, zero deduction. Okay. I don't know why they're hating on lawyers, hating on accountants. They're professional athletes is another one. They're hating on us. So if you are over, so here's the rule. If you're over a single, and taxable income over 241,950, married and taxable income over 483,900, nothing. You get nothing. Bummer. All right. There's really there is no real silver lining for this. Why is this important? If you are forecasting revenue, total taxable income of 500K, you should plan to reduce that as much as possible to get these tax savings. Okay. Pay your kids, give to charity, invest in retirement accounts. All right. Move your money around. Okay. No, don't do that. Don't move your money around. But these are some things that you definitely could do. Okay. So you do want to know um, what you're doing. By the way, when I said move your money around, what I really mean is if you have, and I'm typing this out, but if you have the opportunity to create a separate business that can bolt on to your current specified service trader business, then you might want to do that because each business goes through its own math. Okay. So if you have a separate business that is, let's say, the pie company, and you have a law firm, if you are over, if you're over the threshold 483, 900, and you're married, you can still do the calculus with your pie business. Okay. So, for example, you may want to outsource some things from your law firm to a side hustle, a side business that meet that need. Okay. We can talk about that later, but bolt on business is all I'm going to say. Okay. That is sort of the spiel. Okay. The last thing you can do, by the way, is maximize your business deductions. That's why one of the things that we do for all of my bookkeeping clients is quarterly, we do a little bit of analysis of where you are and where you're going. And we start putting these strategies and ideas in your head before the year is over so that you can actually implement them. Okay. But that's it. This is the biggest tax break I'm sure that you've never heard of. And it is big. 20% is nothing to sneeze at. And as you can see, if you are not a specified service trader business, you still get a pretty good discount, even if you are over these numbers. Okay. And by the way, this is another thing to consider. If you are over these numbers, you want to make sure that you are thinking about these two things and, maximizing sort of both of them to maximize your deduction, right? You want to have high QBI if possible, and you want to have high wages, or you want to kind of split the difference in some way if you can. Hopefully that makes sense. There's other math to be involved, but this is the reason I want you to know about this so that you can think about it, so you can analyze, okay, so that you can, you know, plan it out. Like this business that you're in, this tax stuff that we're talking about, it's a game, okay? The game has rules. Let's win the game. All right, that's it for today. If you'd like to subscribe, follow, ask me a question, do whatever you want. If you need some help, reach out. All right, that's my call to action. If you need some help with your books, reach out. Let's go.